This is a situation where I was always growing up in this kind of Wall Street environment where it was sell in May and go away for a good reason. But it seems as though the market narrative has changed. How much of this is because of a normalization, if you will, of markets since the ultra low interest rate regime, since the great financial crisis?
Well, that certainly is attributed to some of the market growth. I think really what's fueling the market is this resilient consumer that we have, and jobs continue to remain strong. You know, you have 10 million job openings for 6 million unemployed. So as long as the job market remains strong, the consumer should continue to remain pretty resilient. There are little hints of some cracks, if you will, in what could be, you know, potential downside on consumer spending, and we're watching it really closely. It's really closely related to kind of the credit cycle and the credit crunch that we've been noticing.
The credit cycle and credit crunch is something that's playing out not just among the retail consumer spending side of things, but also in the way that the market perceives it. What exactly are those signs telling you right now about the future of consumer spending? It seems to be that's the reason why the economy is doing pretty okay. That's the reason why people still have jobs aplenty in this country right now.
Well, like I said just previously, that we're beginning to see some signs of stress on the consumer. One indicator came out recently, and it's on an index for non-performing loans that jumped to 14.8% in June, from 4.5% in May. And so clearly, you know, the tightening that we're seeing from the Federal Reserve is having its effect, albeit a little bit slightly on the consumer, but we're beginning to see signs of some stress.
Okay, if there is that stress, why is it that markets keep on pushing valuations higher and higher and higher? It's not necessarily just AI driven, but there's a whole slate of companies in the S&P 500 that are now at elevated levels, trading above their long-term trend lines. What types of things are telling you that maybe is a sign of too much froth in the market right now and that we might be due for a pullback?
Valuations are astronomical in some sectors. You mentioned AI. We pulled some chips off the table in that, and we, as a long-term investor, we think AI, definitely has a play in long-term markets. However, at the current valuations, we anticipate some downside because it is frothy, as you said, and behaving somewhat bubble-like. There are some pockets, and globally, there's some regions that offer better value. Japan is one that we're more constructive on, and so we're not calling for a recession at this point in time, but we are concerned towards the latter part of this year and into 2024 that we'll see some economic slowdown, and we're hoping that we're able to execute a soft landing, if you will. A lot of that is dependent on the Federal Reserve and monetary policy, as well as regulations. Some news came out that kind of hurt the AI sector, and that's in alignment with some new possible regulations that will prevent supply to China. And so, it's a very fluid situation, and it's one that warrants disciplined investing. This is not one that you can just throw money at the wall and everything sticks. You definitely have to do your homework and maintain your disciplines.